This wasn't panic, this wasn't fear, and it definitely wasn't random. What you just watched in silver was a mechanical event, a switch getting flipped inside the financial system that most investors don't even know exists. Prices didn't fall because sentiment changed. They fell because the structure of the market forced them to. Silver didn't crash, it was released. For years, people were told that silver trades like any other commodity: supply, demand, buyers, sellers. But that story collapses the moment you look under the hood. Because silver doesn't trade like oil or wheat, it trades like leverage. And leverage only works until the rules change, and the rules just changed. The key mistake most people make is thinking price moves first. It doesn't. Structure moves first. Price is always the last thing to react. By the time you see a red candle, the real decision already happened somewhere else. Inside clearinghouses, margin systems, and balance sheet rules written in language most people never read. This crash began weeks before the chart moved. In the paper silver market, almost every large position is built on borrowed credibility. Futures contracts backed not by metal but by margin. Small deposits controlling massive exposure. That system survives only if volatility stays contained and trust stays high. Once either breaks, the unwind is automatic. And this time, volatility wasn't the trigger. Regulation was. BASEL III didn't arrive with a press conference or a headline. It came quietly, through capital treatment rules that reclassified what counts as safe on a bank's balance sheet. Under these rules, unallocated precious metals, paper claims, synthetic exposure, derivatives, stop being neutral. They become expensive. That single change altered the incentive structure of the entire market. When banks are told that holding paper metal now requires more capital, they don't argue. They exit. Not emotionally, systematically. They reduce exposure, they net positions, they shrink balance sheets, and when the biggest players step back, liquidity vanishes instantly. That's when the trap snaps shut, because the paper-silver market isn't deep, it's wide but thin. It looks liquid until everyone tries to move at once. When banks reduce risk, margin requirements jump. When margins jump, leverage players are forced to sell, not because they want to, but because they have to. This is where retail gets destroyed. Retail traders think stop losses protect them. They don't realize stops become sell orders into a vacuum. When forced liquidation starts, price doesn't search for value. It searches for bids. And when bids disappear, price falls until pain stops. That's why the drop looked violent. That's why it looked irrational. And that's why it didn't bounce, because this wasn't selling driven by opinion. It was selling driven by obligation. The real signal wasn't the price. It was open interest collapsing at the same time volume spiked. That combination only happens during forced exits. Voluntary sellers scale out. Forced sellers dump everything at once. Another clue was how fast the move traveled across contracts. Front month, back month, options, all repriced simultaneously. That doesn't happen from news. It happens when clearing systems demand cash now, not later. This is what a margin-driven unwind looks like. And here's the part most people miss. Once this process starts, it doesn't care if silver is undervalued. It doesn't care about mining costs. It doesn't care about industrial demand. Structure always overrides fundamentals in the short term. History proves this. In past silver crashes, the biggest drops didn't come from bad economic data. They came after rule changes, margin hikes, or balance sheet stress. Every major collapse followed the same pattern. Leverage built quietly, then rules shifted, then liquidation cascaded. This time is no different, except the backdrop is worse. Global banks are already constrained, liquidity is tighter, collateral is scarce. When Basel III raises the cost of paper exposure, the system doesn't absorb it smoothly, it convulses, and that's why this move matters. Because structural unwinds don't end where people expect. They overshoot, they force capitulation, they flush out anyone relying on leverage or paper promises. Only after that process finishes does price regain meaning. So what happens next? There are only three paths from here. 1. Liquidation completes quickly, weak hands are gone, and price stabilizes, but only because the market is smaller, thinner, and less leveraged. 2. Volatility triggers additional margin adjustments, forcing another leg down before stabilization. 3. Confidence in paper silver erodes further, creating a disconnect between futures prices and physical availability. That third scenario is the one institutions are watching closely, because when paper credibility cracks, price stops being the signal. Premiums do. The irony is brutal. The more paper selling suppresses price, the more physical demand tightens, and that tension can't last forever. This is why the crash feels wrong. Because it is wrong, structurally. Silver didn't fail. The paper framework around it did. If you're watching this trying to decide what to do, understand this clearly. The danger wasn't volatility. The danger was leverage you didn't know you were exposed to. There are three types of viewers right now. Those who think this was random, those who think this is over, and those who understand that structural events change markets permanently. If you're in the third group, you don't chase price. You watch rules, margins, and balance sheet pressure. That's where the next move will come from, not headlines. Comment below which group you're in. And if you want the next signal before price reacts, stay close.